Assalamualaikum, my name is IKMAL. On this video, I'm going to present about Cyberpreneurship Chapter 6 Financial Planning. Okay, let's start with definition of financial planning. Financial planning is the process of estimating the capital required and determining its competition. It is the process of framing financial policies in relation to procurement, investment, and administration of funds of an enterprise. Okay, next we move to objective of financial planning. Financial planning has got many objectives to look forward to. Okay, first objective is determining capital requirement. This will depend upon factors like cost of current and fixed assets, promotional expenses, and long-range planning. Capital requirement have to be looked with both aspects, which is short-term and long-term requirement. Okay, next, determining capital structure. The capital structure is the composition of capital, the relative kind and proportion of capital requirement in the business. This includes decision of debt, equity ratio, both short-term and long-term. Framing financial policies with regard to cash control, lending, and borrowing. Lastly, a financial manager ensures that the scarce financial resources are maximally utilized in the best possible manner, at least cost, in order to get maximum return on investment. Next, importance of financial planning. This ensures effective and adequate financial and investment policy. The importance can be outlined as adequate funds have to be ensured to suit with your budget. Next, financial planning helps in ensuring a reasonable balance between outflow and inflow of funds so that stability is maintained. Third, financial planning ensures that the supplier of funds are easily investing in company, which is exercise financial planning. Next, financial planning helps in making growth and expansion program, which help in long-run survival of the company. Next, financial planning reduces uncertainties with regards to changes market trends, which can be faced easily through enough funds. Lastly, financial planning helps to reduce the uncertainties, which can be a hindrance to growth of the company. This helps in ensuring stability and profitability in concern. Okay, next topic is financial plan. All business plan, whether you are just starting a business or building a plan for an existing business, you should include this following: profit and loss statement, cash and flow statement, balance sheet, sales forecast, personal plan, and a break-even analysis. Profit and loss statement. A profit and loss statement is essentially an explanation of how your business make a profit over a certain period of time. There is 3 points here. Your revenue, also called your sales, your cost of sale or cost of goods sale, and the last one is your gross margin, which is your revenue less of your COGS. Cash flow statement. A cash flow statement, also called a statement of cash flow, is an explanation of how much cash your business brought in, how much cash it paid out, and what its ending cash balance was, typically per month. There are two methods of accounting: the cash method and the accrual method. The cash method means that you just account for your sales and expenses as they happen, without worrying about matching up the expenses that are related to particular sales or vice versa. The accrual method means that you just account for your sales and expenses at the same time. If you got a big pre-order for a new product, for example, you wait to account for all of your pre-order sales revenue until you actually start manufacturing and delivery the product. Okay, sell forecast. The sell forecast is exactly what it sounds like. Your projection or your forecast of what you think you will sell in a given period, typically a year to 3 years. Your sales forecast is incredibly important part of your business plan, especially when you leader or inventor are involved, and you should be ongoing part of your business planning process. Next is balance sheet. The balance sheet is standardized and consists of 3 types of account. First, asset, which is account receivable, money in bank, and inventory. Next is liability, which is account payable, credit card balance, and loan repayment. Next is equity. For most small businesses, this is just the owner equity, but it could include inventor, share, retained earning, and stock proceed. It's called a balance sheet because it's an equation that need to balance out, which is asset equal to liability plus equity. Personal plans. The importance of the personal plan depends largely on the type of businesses you have. If you are sole proprietor with no employee, this might not be the important and could be summarized in the sentence of 2. Business ratio. You probably want some profitability ratio like gross margin, return on sale, return on assets, or return on investment. And you probably want some liquidity ratio such as debt to equity, current ratio, and work capital. Of this, the common ratio used by businesses owners and requested by bankers are probably margin growth, return on investment, and debt to equity. I hope you enjoyed my video presentation, and that's all from me. Thank you.